I would say the quality of the promoter group is one of the most essential things that investors should focus on while deciding on an investment decision. It works at broad levels. I mean, I think intuitively all investors understand it, which is why traditionally groups like the Tata Group, etc., have commanded a lot of respect and premium from investors. So the idea that the person who owns and runs the company actually shapes the investment return is sort of embedded in investor minds. But it works at various levels. Is the promoter young, or more or less belongs to the new generation, is fully seized with the kind of technological and new age changes which are happening in the world and can respond to it? That is so critical. What about aggression? Going out and acquiring companies, being swift to move to new lines of business when the opportunity arises. That level of aggression, if it's not seen in promoters, chances are that investment returns will not be great. The big factor is capital allocation. Because capital misallocation can be one of the biggest reasons for destroying shareholder wealth. And on capital allocation, promoters play a very, very fundamental role. And over the history of many years, by analyzing promoters, that they have a good eye for capital allocation or they're wasteful, and that is something which determines what kind of investment returns you get from a particular company. And finally, I would imagine the ethical framework of a promoter is very important, because if you have a promoter who's actually not focused on creating shareholder returns, is more intent on what the company can give to him rather than to all shareholders, then fundamentally you're getting into a business which will not deliver returns. So I would say for all these factors, the promoter quality is absolutely critical. Well, I just mentioned a few like the Tata Group, which over a period of time have delivered great returns. The classic case was also of the technology companies. When companies like Infosys, TCS became big, the first thing which struck you was these were a different kind of a breed of promoters. They were trying to create, they were not lalas, they were trying to create genuine wealth for all shareholders. And I think people have that impression of technocrats running companies, doing things for all shareholders, and those are the memories of good promoters creating great shareholder returns. But I want to focus more on the other side of it, which is how a promoter which is not efficient or competent can destroy shareholder returns. And I cannot think of anything greater than the government of India. Look at what PSU stock returns, and it's a very large basket of stocks. What PSU stocks have done to shareholder returns over the years, they have just completely destroyed shareholder returns. Look at oil companies. Good companies, near monopoly businesses, all these oil marketing companies, IOCs, BPCL, HPCL. Just one decision from a company, from the government, saying that this is how the subsidy will be shared this time around. You may or may not raise fuel prices, and stocks lose 20-25% of their value in just a week's time. That is how fickle a promoter can be and how destructive it can be for returns. Look at the case of public sector banks. No great vision on how they will move forward, constantly losing market share to their private peers, big interference from political quarters, lack of incentives for managers to run these companies. It's a classic case of how you should not run a bank, and that has resulted in the utter destruction of shareholder wealth over a period of time. And I think the public sector universe should demonstrate to all investors how critical the promoter quality is. Because if you had owned PSU stocks over the years, chances are you would have lost a substantial part of your capital. In an ideal world, that should be the case, because news moves around very quickly. There are very intelligent people in the stock market. So every potential investor should be thinking, I should not bother too much about promoter quality, because I will get to hear from either the media or from analysts, highly paid analysts, if something is wrong with the promoter. Now, the example which I always keep in my mind about that is that of Satyam Computers, NASDAQ listed company. Every global brokerage investment bank, you would track that company on a daily, weekly basis, bring out glowing reports on that company. And every quarter when they announced results, the results would be, and those were all cooked numbers, by the way, everybody would analyze those numbers down to the last decimal point, and all that the promoter was doing was pulling wool over the eyes of the entire media, the world, and the global investment banking fraternity. And till the day he decided to disclose what he was doing through a letter, nobody had a clue of it. And that tells me that if the promoter wants to hide something, no analyst or media in the world can spot it, because Indian promoters are very, very savvy. So the example of Satyam Computer tells me that you should not wait to hear from somebody else, because it may come too late, as people found out with Satyam. You just construct a basket of things which will tell you at a gut level that a promoter is not right for you, and you just leave that company and do not invest in it. Let other people make money, because one day it may take time to come, one day the investment will blow up in your face, as it did with companies like Satyam. This is a very important factor, because people always think that a good promoter means the performance of the company will be better. That is true. That growth will be higher. That is also true. But it's not just the relationship between promoter and performance and growth. It is also the difference in perception. And perception plays a very important role in creating the PE multiple of the stock. You see, the stock return for any, or the investment return for any stock depends on two things. One is, what is the underlying performance of the company? But the other thing, which is a little bit more nebulous, is what is the market's perception of the company, which comes through in the PE multiple. So the stock price is nothing but a multiplication of the PE multiple and the earnings per share of the company. Now the EPS is one thing, but how do you arrive at the PE? And I'll give you the example of the HDFC group, which to my mind is one of the classic examples of how the perception of a good promoter can bolster its PE multiple. HDFC Bank has always been the most expensive bank in India because of the perception that the promoter is strong. HDFC Limited has always been the most expensive housing company in the country because the perception that the promoter will not do anything against the shareholder interests. And this, to my mind, is a classic example of how investment returns can actually be much superior if the market perceives that the promoter is clean and strong, and therefore is very important in figuring that one out.